Hi class, in this video clip we're going to talk about chapter 11 learning objective 3, which is about the dividends of the stock. Okay, so let's get on that. Alright, so for common stock or for any kind of stock, we have some dividends to pay to the stockholders, to the stock owners. Okay, so the investors or the owners of the business, right? And there are several types of dividends that we can issue to those owners if we decide as a company, if we decide to declare some dividends to the owners. Okay, otherwise, as we said before in the last video clip, we are not required to issue dividends to the owners. It just depends on the company's strategies and policy and something else. Okay, so if we are as companies decided to declare some dividends, there are several types of dividends we can issue to the owners. And the first is cash dividends, and first is cash dividends, and second is stock dividends, and something else is called stock splits. Okay, so for these three different types of stock dividends transactions, we're going to look at how we're going to record the journal entries. All right, so first of all, cash dividends on common stock. Okay, so it is declared by the board of directors. Okay, so if the company is going to issue some dividends to the investors, who is going to be the person who decides to declare the dividends or not? That'll be the responsibility of board of directors. Okay, not CEOs, not CFOs. It's board of directors. Okay, and as we said before, dividend is not legally required, and it requires liability at declarations. And also it requires sufficient retained earnings and cash. And why is that? Because it's cash dividends, right? So when we declared dividends, payments for the payments to owners in the future, then we have to have enough cash to cover this part of dividends, right? And also, if we are not earning any profits this year, then that means we are not able to declare any dividends because we don't have any money left, right? So that these two things are very critical. First of all, you have to have a sufficient retained earnings. Second of all, you have to have enough cash to pay off your dividends. Okay, and why is create liabilities at declarations? We're going to talk about that at different dates. Okay, so now let's look at very critical dates for the cash dividends declarations. Okay, so first is declaration date. It is the date when we declare we're going to issue some dividends to the investors. Okay, and second is the date of record. It is by that specific date. For example, let's say our declaration date is January 20th, 2020, and date of record is February 2020. February 20th, 2020. Okay, and date of payment is March 20th, 2020. Okay, so those are three different dates, and we're going to talk about the year end a little bit later. Okay, so first of all, when we declared cash dividends on January 2020, January 28th, 2020, and we are saying this. Okay, so in by the date of February 20th, 2020, whoever owns our common stock will have the rights to receive this cash dividends. Okay, so by the date of February 20th, 2020, whoever owns our common stock are able to receive this dividends, and then we're gonna process our cash to get enough cash. And on this date, March 20th, it is actually the date we issue the payments to our stockholders or investors. Okay, so actually it is by this date, if we're assuming that there's no time lag between transactions between bank and bank, and then this is the same date, and this is the same date when the investors will receive the money. Okay, so when we declare that we are going to issue common stock dividends to the investors, and then at this date we are create a liability. Okay, we create a liability. What that liability is a dividend something. Okay, and so why there's a time lag between declaration date and date of record? That is because we don't have enough time on that date to pull out information saying that, okay, who is on what, how much share of common stock of my company, right? And I don't know who owns that. So it gave us a little bit time to process that kind of information, and on that date, okay, whoever owns, and probably actually we get all the information who owns how much of our common stock, and then based off on that we calculation the dividends and pay them off on the date of the payment. Okay, so year end is when it's come to the year end, if some of these dates fall into year ends fall into between any two of these three dates, and then our accounting treatment is going to be a little bit different. Okay, so that is because we have to use accrual accounting basis, right? Accrual accounting basis. Okay, so my remote monitor is a little bit glitching and just not respond very well. Okay, so now let's look at how we record this journal entry. All right, so first is dividends date examples, and that is the declaration date. Okay, so National Beverage declares a cash dividend of $238 million during its 2016 fiscal year, and we're gonna do the following journal entries. Okay, so because at this date, the declaration date, we create a liability, so we have to record a liability. Okay, so on this date we record as debit dividends. So that means we are going to pay that much dividends, right? But we're not paying that now. However, we are promising that we're going to pay you in a future date, and that creates our liability, which is dividend liabilities, dividends payable. Okay, so then we debit dividends and credit dividends payable, and for whatever the amount that we declares the cash dividends for. Okay, and second is the date is paid, the date of payment. National Beverage paid the previous declared cash dividends of that much, so we actually paid off by cash, right? And then we'll decrease the cash assets balance and decrease the liability balance, which is dividend payable. Then we record as debit dividends payable for that much, and then credit cash for that much, and then we paid off our dividends payable, the liabilities. All right. And then all temporary accounts include dividends are closed into retained earnings at each accounting and year end. That is when we have that closing process, right? We're closing process. We have two parts to close, and that is first is revenue and expense, and second is dividends, right? And what we use to close these three temporary accounts, we use retained earnings, right? We use retained earnings account. Okay, so when we have dividends account, balance, and we need to close it to retained earnings, and we're going to do this following journal entries. Okay, so dividends balance is debit balance, right? It carries a debit balance. So normally what we have is dividends, and the balance is on the debit side. Okay, and if we will need to reset it to zero, then we need to credit that much, right? So then we need to credit $238 million, and then debit retained earning for that much. Okay, then the dividends balance will be zero, and then ready for us to start off the next accounting period, right? So that will be debit retained earnings and credit dividends, and for that much. Okay, whatever the balance is. All right. All right. Then that is about cash dividends. Okay, so basically we're going to do three different journal entries. One is at the declaration date, it creates a liability, and we record dividends and dividends liability. And the second one is at the date of payment, which when we pay off cash dividends, reduce cash balance, and then paid off liabilities, reduce dividends liabilities balance, dividends payables balance, right? And then it's at the end of the year we have accrual analysis, okay, and also we need to reset that to 0, the temporary account. And now we're talking about stock dividends, okay? So stock dividends is basically that, okay, company says that, all right, we don't want to issue any cash dividends because probably we're gonna start spend cash onto some new projects next year, and we're gonna spend cash somewhere else to grow our company. So better way to return in terms of return our common stockholders benefits. Now we are issuing some additional shares of stock to stockholders. Okay, so then you are not going to receive cash as dividends, but you're going to receive additional shares of common stock of the company as the dividends. Okay, so all common stockholders retain same percentage ownership. Okay. So there's no change in total stockholders' equity, and there's no change in par value. There's nothing changed, just you receive additional shares, okay? And so there are two different types of stock dividends. If the stock dividends is less than 25% of the company's total issued stock, then we'll just record at its market value. Okay, so let's say your market value, the selling price now is let's say it's $50. Okay, then you just record these stock dividends at the $50 per share. Okay, but if you are issuing more than 25 of your overall issued common stock, then we have to record at par value, okay, at record par value, and then the premium amount we're gonna record it in additional paid in journal entry, okay. And journal entries move the amount from retained earnings to other equity accounts, which is common stock accounts or additional paid in accounts. All right, now look like this. Then it's so for journal entries, really you don't really gonna work on these journal entries for stock dividends because it's a little bit complicated. And for us, you just need to understand how to record journal entries for cash dividends, and that'll be enough. All right. Okay. So next, stock splits, okay? An increase in the number of shares and a corresponding decrease in par value per share retained earnings is not affected. So what is stock splits is that really companies, for example, Coca-Cola, for companies who is running more than so many years, and then they are on the stock market for so many years, right? So probably Coca-Cola is on the market almost about 100 years, okay? If they don't split their stocks, and their stock price is always going to be increasing, right? So let's say it's first to start off like several cents, let's say 1 cent per share in 2029. Okay, and now after 100 years, and probably it's about like, if we don't do any stock splits, probably now it's gonna be like $1,000 per share, or $10,000 per share, or $100,000 per share. Who knows, right? So you got an idea. So by the time, if they don't do any stock splits, by the time now, because their stock price is so high, then it prevents their mobility of circulation between from stockholders to or other investors, right? So because this price is so high, not a lot of investors on the market has the enough economic power to purchase their stock, right? So by doing stock splits, they can really cut the stock price by half. Okay, so theoretically speaking, all right, by half. So what stock splits means, that is, all right, my total value of my stock, it doesn't change. In total, if it's my stock value is $100 million, it's still gonna be $100 million. And now I just cut each slide into a smaller pieces. Okay, so before we're probably gonna cut the pie into 1, 2, 3, 4, 5, 6, 7 pieces. Okay, now I just want to cut it even smaller. Okay, now I split the pie into smaller pieces. Okay, so now the par value is going to be reduced by the corresponding. All right, assume the corporation has 1 million shares of 1 cent par value common stock outstanding before a 2-for-1 stock split, which means one current share is going to be split into 2 shares. Okay, so the total value, par value doesn't change. It's going to be 1 cent for a share, but after the stock split, 1 share now becomes 2 shares, and in total the share par value still doesn't change. It's still going to be 0.1 cents together, but now the per share of common stock par value becomes 0.005 because 0.005 times 2 shares equals 0.01. Okay, so in total it is the same, but on a per share basis it will decrease. All right, so see, the total stockholders equity is still going to be the same. All right, it's still going to be the same, and retained earnings, par value outstanding is still be the same. Okay, but the number of shares outstanding before the split is 1 million shares, and now it becomes 2 million shares because one previous share now becomes 2 new shares, and previously it is 1 cent per share, and now it's 0.05 cents per share. Okay, 0.5 cents per share. Okay, and retained earnings the same, and then the total stockholders equity value is going to be the same. All right, in total it doesn't change. Okay, so comparison and distribution of stockholders equity. So before anything, now we have 1 million shares of outstanding common stock on the market for circulation, and par value is 1 cent per share, and total is $10,000 per share, the par value, and then additional paid in for this $1 million is $30,000, and retained earnings $650,000, in total is $690. All right, so after the stock split, our total stockholders equity doesn't change. What only change is the number of outstanding shares now becomes 2 million shares because it's 2 for 1, right? One existing common stocks now split into 2 new shares. Okay, and the par value will decrease correspondingly. All right, and then after the stock dividends, our par value doesn't change. Okay, our par value doesn't change, and now outstanding shares is more. Okay, and then our common stock par value increased to $20,000 because we issued more stock, right? We issued 100% more, so we're gonna have 2 million shares. However, our additional paid-in is the same, and retained earnings is decreased by $10,000. Why is that? Because this $10,000 becomes this additional par value. Okay, additional par value. All right. So it's still $690,000. All right. So it doesn't matter if you're gonna do stocks dividends or stock splits, your total stockholders equity doesn't change. Okay. So one thing for for stock splits, things change is number of outstanding shares and their par value. For stock dividends, that thing changed is your retained earnings will be reduced for corresponding amount, and then your par value will be increased for the corresponding amount. Okay, depends on the number of shares you declare. Okay, and if it's net $10,000 cash dividends, okay, anything here doesn't change, but this will be decreased by $10,000 because you really use the retained earnings to pay off $10,000 cash dividends. That will reduce. That is the claim of owners, right? The withdrawal of owners out of the company assets. Okay, so that will decrease your stockholders' equity. All right. So now let's look at some example. Okay, discard. And where is the board? Right here. All right. On May 20, the board of directors for Auction.com declared a cash dividend of 50 cents per share payable to common stockholders of recorded on June 14th. Dividends are paid on July 14th. The company has 500,000 shares of common stock outstanding. Closing entries are recorded on July 31st. Prepare any necessary journal entries for each date. Okay, so on May 20th, the board of directors declared a cash dividend of 50 cents per share, and we have 500,000 shares outstanding. So then we do the calculation. That will be $250,000, right? So then we're going to record as debit dividends for $250,000 and credit dividend payable for the same amount. Okay, and now it comes to the date of payment, which is on July 14th. Okay, July 14th. And on this recorded date of record, we don't do anything because it's the only date for the company and the investment agency, financing agency to gather the information that who owns how much shares of the common stock, right? So there's no accounting record at all. But on the date of payment, we do pay off this cash dividends. Then it will decrease our liability. So our dividends payable, the current liability will decrease by that much, $250,000. Okay, and then we're paid it off by cash, so cash balance will decrease by $250,000. Okay, and now look at the May 20th journal entries. Now we record a dividends balance. Right now the dividends has a balance of, assuming there's no dividends balance before and after this transaction, we're gonna have a dividends T account, and then this balance is gonna be $250,000. Now remember, for this company, the closing entry, which is the fiscal year end, is on July 31st, which is the fiscal year end. So that is when we should prepare the annual financial journal entries and annual financial reports. Okay, so then that is the time when we have to reset all this temporary journal entry to accounts. Okay, so now as we need to reset all this temporary account balance to zero, so for a debit balance account, the dividends, we're going to credit dividends account by the carrying balance $250,000, and we reset it off to retained earnings. Okay, now the retained earnings will decrease by this amount, $250,000, and then by having this credit balance journal entry, then we'll reset it off what happened? We reset it off. What is flying? 250,000, and we reset it off to zero. Okay, excuse me, it's on the other side. Okay, we set it on zero. Okay, and now the annual balance of dividend balance is zero, which is the beginning balance of next fiscal year, right? So it's a zero balance and it's a fresh start. All right. So now let's look at the other one. Okay, so this one is for learning objective 11.4. So we're gonna talk about the next video clip. All right. So this is so far for this video clip.